All right, we actually have a team of speakers for this next presentation. We're going to have Michael Rome, Brett Isenberg, and Justin Dabrowski are going to talk about fixing income for the masses, how Octet next is democratizing trade finance for all. So let me tell you a little about our speakers. Michael has a strong entrepreneurial background in technology-based ventures and is a qualified charter accountant, which means he thinks kind of like I do, I imagine, and has acted in this CTO and COO role for over a decade. He is a co-founder of Octet Next. His partner, co-founder Brett Isenberg, comes with banking experience. He was at the business finance at Scottish Pacific Business Finance Bank of Scotland and Oxford Investment Groups before joining Octet to grow the business transaction part of their business. And then they also have with them Justin Dombrowski, who is CEO and founder of Soho and an advisor to Octet Next. And his mission through Soho is to create a new generation of asset classes for the next century, basically for the 21st century. They work with established businesses looking to raise growth capital. So they make a wonderful triumvirate. And I'd like to welcome these three gentlemen to our platform, and would you please give it up for them? Thank you.
Finish, and we'll just swap.
Hi everyone, my name is Brett Isenberg. I'm the Chief Commercial Officer of Octet Group. We're a fintech or financial technology business based out of Asia Pacific. We specialize in supply chain financing, and our business is made up of essentially two components. One is a corporate or corporately owned finance company that lends to about 3,000 SMEs within Asia Pacific. And we do about $3 billion in loans annually and enable payments to about 40,000 suppliers across 72 different countries around the world. The other side of our business is actually a supply chain financing platform as a service business, and we build platforms for 12 of the world's largest banks, including HSBC, Westpac, Hang Seng Bank, Bank of Nanjing, and several others. I'm here today to talk to you guys, as my team, about supply chain financing, its current state and where we think it needs improvement, and potentially where we can provide that improvement, and how decentralization fits into the picture. Sorry. Okay. So, supply chain financing, in our opinion, is somewhat broken. It's really broken into two parts where it's failing at the moment. One is, invariably, people know that for the most part, banks control this ecosystem, whether it's through the origination of debt or opportunities, which they obviously control, but also on a transactional level, most supply chain financing is very old world, heavily manualized, and as opposed to letting an importer and an exporter communicate, or a buyer and a supplier communicate and trade seamlessly, invariably most banking parties get in the way and essentially have done so for nearly a century in the form of letter of credit or just traditional international factoring. The other facet to the industry that we see as being inherently flawed is that most of the flows, and in total it's about $3 trillion, go through a centralized network called Factors Chain International. Now, Factors Chain International, I like to refer to as kind of a hybrid between Craigslist and Swift, and essentially a network of 600 banks and financial institutions. And what they do is they basically provide counterparty financing opportunities through the network. So one bank who's financing an importer will have, obviously, flow to offer a financier on the other side who's financing the exporter, and vice versa. So essentially they, as you can see in the diagram when it comes back up, facilitate traditionally have facilitated equal flow between members. So it's essentially, as I said, a network of FIs. What's happened in recent years is that essentially, and I'll skip to this now, and due to the centralized nature of this community, is that about 10 of the 400 to 500 member banks, really the largest member banks in the world, so including Wells Fargo, BNP Paribas, HSBC, etc., have really started to hoard flows and somewhat turn the space into an oligopoly. And how that works is really every time an independent financial institution puts up a deal, the largest bank in that area, in that network, will essentially take that client off the FI and find a corresponding equally large bank in another jurisdiction to do their letters of credit and international factoring with, and therefore serving very little value to the other 400 members in the network. Obviously, we see this as a major problem and a flaw, having worked with groups like this in the past, and unfortunately in the last 12 to 18 months, we've now seen about 100 to 150 members leave from the network, and the top 3 to 400, executive members too. So Octet Next is really our interpretation of the next generation of supply chain financing networks. What we want to do is decentralize both the financial institution network that originates deals and also decentralize the source of funding to come from an investor pool, really a peer-to-peer investor pool of token holders. So why we see this as important is because in the industry now, it's a growing industry, there's still $1.5 trillion of unmet financing needs. In the banking world as well, since the GFC, things like Basel III and Basel IV have actually made it harder for banks, particularly smaller banks, to lend to SMEs because they're required to hold more capital on their balance sheet for each new loan that they originate. Groups like FCI have also tried to inhibit innovation and adoption of new technologies, which is obviously something that's only done to protect its larger members. And to be honest, beyond that, invariably people are used to putting their money in the bank for 1% and not being party to the potential flows that a group like this could contribute. I will now hand off to my colleague Justin to kind of highlight the villains in this case a little bit more and explain more about what we do.
I've got this. Oh, still. Thanks, Brett. Hi, everyone. Thanks for sticking around, by the way. Forgive my soreness of voice at the moment. I'm still getting over a cold. I just want to highlight a few things just to sort of encapsulate where Brett was coming from. So really what he's after is trying to identify the villains in the supply chain finance world. We can just call them centralization, technology, and financing needs. What do we mean by that? The whole point about FCI is to highlight the fact that historically there had been a group of 600-odd financial institutions that effectively worked together to streamline the entire supply chain financing process. Since then, basically what's happened is the entire organization is atrophied. Tons of them have left, circa 200 or so. Their top brass have all left the organization. And what's effectively happened is you only have a small number of different institutions that are running the entire show. What does that mean? It's forced out a lot of capital from the organizations, or from the different financial institutions, and made it very difficult for a large number of them to lend. And what they've effectively done is cemented themselves in between buyer and supplier relationships. And why is that important? It means basically that they get to entirely govern the commercial relationships among them. So that's the centralization piece. Centralization is effectively bad for these kinds of businesses. It's bad for trade finance. And the next point with technology is one of the things that FCI was supposed to do was bring a whole host of range of different types of technology changes to make it more efficient for buyers and suppliers throughout the supply chain financing world to be able to interact with each other more effectively. But here's what's happened. As they've increasingly aggregated their power, they've become increasingly sticky. The idea of introducing new technology to decrease that stickiness is therefore unpalatable to them. Why would you actually decrease your role within global trade finance if it meant that you could capitalize much less? So they've decided, you want to know what? Things like EDI messaging that are supposed to be good for the world, we don't really care that much about it, never really worked to begin with, so we're just going to leave things the way they are. And then the financing needs. financing needs, in a way, has less to do with FCI, has more to do with Basel III and Basel IV, as Brett was mentioning. In this case, think of it this way. Right now, the sum total amount of financing needs globally that are required to make the supply chain actually work well, that's unmet, is about $1.5 trillion. It's not a number that you hear very often. It comes from the WTO. It's a shitload of money. It's a lot of money. And because that cash isn't easily available, a lot of different buyers and suppliers can't actually conduct their businesses effectively. What is the problem with Basel III and Basel IV? Basically, what it boils down to is you have lots of FIs that would love to be able to lend to smaller businesses, but can't because of the capital adequacy that Basel III and Basel IV require them to have. So what that effectively means is there's crap loads of loans sitting just out in the ether that nobody can take, nobody would even love to take, but they're unpalatable because of what's required for them to take them from a capital adequacy standpoint. So you've got tons of small to medium-sized enterprises that would love to get cash, but just can't get it, and even FIs that would love to give it, but they can't. So the question comes, for us, how the hell do you go about trying to fill those coffers for SMEs? How do you actually create the wheels of commerce much more effective than what they have been historically? So we decided, so Octet, as Brett was mentioning, established supply chain finance business, links buyers and suppliers to FIs already. They've got an established network. What can you do as a business like that to democratize the entire supply chain financing world? So we kind of think of it this way. How can you try to solve this nexus of problems all at the same time? We want to democratize supply chain financing so that anybody can participate. We want to have a world where ordinary people, you and me, wealthy individuals, whoever, who have cash lying around can contribute it to a network and have it go to work, but to do so in a risk-free way, in the same sort of way that an ordinary financial institution would contribute to a loan, fully underwritten, risk-adjusted, all the due diligence done, legit financing opportunities, and really to use that capital as a way to begin to fill some of that $1.5 trillion of need on the table so that businesses can thrive. So this is really, at its guts, what Octet Next is all about. Put simply, Octet Next is a platform. It's a crypto-based platform. It's an F fork that makes it possible for ordinary people throughout the world to participate in, proper fixed income products, basically to contribute to the supply chain financing needs, and in a very easy and accessible way that makes it possible for other businesses that need that financing to get access to it. That's really what this is about. So think of it this way. So just at a very high level about the tech behind it, and we can talk about the processes later if you like. But it's effectively a fork of Ethereum. It's its own POA chain, a proof of authority chain, so it links back into ETH to illustrate the states as they are. As a platform, it provides a whole range of services. A number of them are straight supplied by smart contracts on the ledger. Some of them are also talking to existing systems that we have or that other businesses do as well. At the moment, the kinds of things that it's meant to do is provide low-cost FX using crypto and like basically Bitcoin, ETH, and anything else you've got, as well as our own internal cryptocurrency called the Next token, which we'll talk about in just a moment. And in addition to that, what it also enables users to do is to contribute directly to loans that we source and that have been completely underwritten. And that's particularly interesting because of the rates that are at stake there. And we'll have Mike talk about those more in a little bit. So that's the guts of it. So imagine this process. So let me just give you a high-level illustration about, when we talk about pooling of assets for loans, what exactly does this process look like? So imagine you're a buyer or supplier, and you need, say, $500,000 in credit. And the trouble is that you're a small business, and so FIs might ordinarily love to be able to lend to you, and chances are aren't going to because of the capital adequacy needs that they would have in order to do so. So what our platform then does is it makes it possible for an FI, like up at the top, to take, maybe they only legitimately can take about 80% of the loan, right? That's the amount that they can afford without having to take on equity, that's fine. So they'll offer that, but then via the platform, what ends up happening is if you're a user, if you're someone who's a funder to the network, you have a pile of Bitcoin, you have a pile of ETH, it's been sitting there, maybe you're using it for ICOs and other things, but you want to also let it contribute to other use cases because you're a more mature investor and you're like, you know what, I want some of this stuff to tick over and earn some revenue for me on the side also. So I actually contribute that to the network. What then happens is we actually have, and I'll talk about some of the contracts in a moment, you actually have a profile. You have a level of risk that you're interested in contributing to. You have a certain type of return that you're expecting, certain business size that you want to fund. All of these kinds of things that effectively look like a list of attributes that on our side, we then go and look for when we find a balance of a loan that we need to fund. So what the platform then does is it goes and looks for potential funders that are already contributors and say, hey, there's Justin, me. He's open to this kind of possibility. We'll reach out to him and a bunch of other people to see if they're interested in funding alongside the FI that's already underwritten the process. I then get a notification. I have an opportunity to examine at a high level some of the terms of the loans according to my own risk and reward, and I can make a decision whether to join the pool or not. So at that point, maybe I take it on, and me and one of my friends say, yeah, we're going to go off and do this. It's anonymous from these guys' point of view. All you get is the opportunity to participate, and then we join. From the seller standpoint, who might be interested in getting on and getting the loan, the borrower, from their point of view, all they do is they see that they get access to the credit. They're oblivious to the entire process. It's not complicated from their point of view. It's very easy, streamlined process. From our point of view, from the funder's point of view, I just have the opportunity to fund or not. And if you're curious about the kind of rates that this actually means, Mike will talk about it more, but we're talking about like 5 to 15% for a loan. So it's a very reasonable return. It's good. It's reliable also. It's a very good product. Now, in terms of how I, as a user, get access to the system, we basically have two sets of types of smart contracts. One group that basically manages the opportunities, more or less kind of like the way a marketplace would, that takes the different loan opportunities and tries to source them, but then it matches them also against a user contract, which basically reflects my own preferences as a potential funder. And it matches those together so that I can actually use that as the basis for the funds. So, and again, some of the interesting things worth mentioning about this is that although we have our own cryptocurrency associated with this, and there are certain preferential benefits that come with using it, you can contribute in other sources of funds if you like. So you don't have to be geographically based in one particular region. You would have to be KYC in order to participate because of the law. But beyond that, anybody can participate. It's pretty neat and clean. And then one other use case that we have is you probably are familiar with the fact that ordinarily, a lot of these buyers and suppliers that are part of the network have to ship large amounts of funds with each other back and forth. FX in general for these kinds of transactions can be relatively expensive. And so one of the questions that we often have is, what can we possibly do to bring down that cost? And the idea is that you can also contribute your funds to a larger FX pool to bring down those costs for users. So from the point of view of the seller, the person who's the Octet member who's sitting on the platform, they have an option. They can select to go with the traditional rate via TransferWise, OFX, or something else, or they can use the next platform and save a number of basis points on the transaction. So it's actually a lot more beneficial for them. Okay, and then, one of the other benefits, one of the things that makes this whole thing run for us is, because FCI historically has been this gigantic network, and because a giant distributed infrastructure is beneficial to the ecosystem generally, we've made the decision that we're going to use a crypto-based platform. Now, this means, from our point of view, that there's a necessary benefit to collapsing not just the financial activity from the point of view of the contracting on the platform onto a blockchain, but also to have an inherent payment mechanism based in there as well. So we have the next token, which is effectively a currency token that performs two functions. One, it's effectively free FX and payments throughout the platform. And the second one is it's actually required, from our point of view, to actually use the contracts for the matching and setting up your identity and things like that. So it has a practical use case there, too. You can sort of think about it in the same sort of way that ETH functions in the Ethereum network. But it actually helps us to bring down the cost for anybody who actually wants to use the platform on the funder side as well as on the borrower side. So it's pretty valuable. Okay, at this point I'm going to hand over to Mike, who's going to walk you through a specific illustration of how this can work.
Hi, everyone. So, can it really work? Well, we think it can, and that's why we're here to talk to you today. My name is Mike Rom. I'm the CTO/CO of Octet Group, and I'm working together with the team on our blockchain project and network platform. And we're here today to share some of our experiences and learnings with you. Just following on from Justin's discussion earlier, just to give a little bit of color to the illustrative examples that he worked through, I'll walk you through, firstly, how supply chain financing works. So supply chain financing is predicated upon a very old and dated and broken system known as the letter of credit. And that letter of credit system has been designed to solve one key problem, and that's the problem of trust. And it's been around for decades to hundreds of years. The idea is that if you look at the diagram, once it pops back up, is that if I am a buyer and you are a supplier, and I want to purchase something from you, how do you know as a supplier that I have the funds, or enough funds, or appropriate funds to be able to settle on that transaction? And how do I know that you as a supplier have the goods to the appropriate condition and quality that I'm expecting as part of our transaction? So because there's a lack of trust that implicitly exists in these dealings, I have to go back to basics. And that means I trust my bank, you trust your bank, and our banks trust one another. So what that means is I can go to my bank and ask them to produce a letter of credit, which is essentially a guarantee that I've got the funds available to satisfy the transaction. And other conditions are entered into that letter of credit, which are the conditions of the goods and what I'm expecting to receive. My bank will then transmit that letter of credit to your bank, and you'll then have custody of that letter of credit so that you're comfortable from a supplier's perspective that if you perform to the contract to supply certain goods at certain quality and so forth, that the funds will be released to you. So this model, as you can see, a key problem with this model is that there's no line in between the buyer and the seller. And that's a huge problem. That means that the banks are in control of our relationship, and that's never a good thing. This model exists on a much grander scale around the world, touching a little bit more into what Brett said earlier, in a network known as FCI, which is around 400 banks, as was said before, across 90 countries with around $3 trillion in transactional volume. FCI was always created to enable trade, but because the underlying core process of the letter of credit is so cumbersome and onerous, it makes business difficult and expensive. So let's talk a little bit about where banks come into the world. Has anyone ever wondered how the banks make so much money and how you don't? Well, let's consider this example for a minute. As there's two sides to the equation. First, on the left side, there's money coming into the financial system, and then on the right side, there's money going out of the financial system in a borrowing manner. So you as a customer, let's say you may have some capital available, say $50,000, it doesn't matter what the number is, and you deposit it into a bank account with any bank. If you're lucky, you'll earn somewhere between 0 and 1 and 2%. And what will happen is the bank will take that money and it will go and find other businesses and individuals or consumers up its risk chain, and it will lend that money to those parties, where those parties will then pay the bank 6 to 15% for the pleasure of access to that capital. Now, the bank is netting the difference, which means the bank is making all that money off of your deposit, not its money, your money. And that just does not sound right. So we've got a problem with that. I'm sure you do as well, and that's the problem that we're here to try and solve and change. This is further exaggerated by the fact that the capital adequacy problem, which is a global phenomenon, as the guys talked about a bit earlier, which means that businesses that want capital are actually finding themselves in a position where they're getting less of it, either wholly or partly. And it's a huge problem, which means that the cost of business is being kept high and the pace of business is being slowed down. Taking a look at, in a micro view of what our model is offering, instead of depositing funds into a bank account, we're inviting anyone, what we're calling in liquidity pools or decentralized networks of people, to be able to place their capital into an already existing ecosystem. Instead of the banks taking those funds and lending it onto those customers, those businesses or individuals, you're able to directly finance those transactions, meaning that you take the lion's share and not the bank. This is important because instead of the bank taking those funds and making that margin, you're able to, because you're supporting the supply chain financing transactions directly. The bank's responsibility in the network is to go and onboard and find those customers and bring them into the network and provide all the diligence and underwriting and credit assessment that we as individuals, myself and yourself, are unable to do. Octet exists in the network to bring authenticity to transactions. It's making sure that the transactions are real, and it's making sure that the risk profiles of all parties in the network are within tolerable ranges. Taking a step back and looking at a macro view, this is more or less what the network looks like. As you can see, most importantly, the buyer and the supplier are directly connected to one another, meaning that they're in control of their relationship and their trading activity. The parties at the top are financial institutions which are part of the Octet network and are operating Octet nodes effectively. And as I said earlier, their responsibility is to go out into their geographies and find customers and bring them into the network so that you don't have to. In all peer-to-peer marketplaces, one of the key problems that they face is that when you are the lender of money, you have no idea who the other guy is on the other side, what quality of risk they are, whether they're going to pay you back, where they are, what they are, and so forth. The idea here is that there's still a hybrid of the centralized and decentralized models coming together, which we think there's a huge, massive opportunity where these financial institutions can perform all this core credit underwriting and risk assessment so that none of us have to. The parties at the bottom are a decentralized pool of individuals or businesses that have capital available to them, and they can place that capital into the network to support these transactions directly. And this means that they're able to take advantage of these transactions and take the appropriate reward as well. And instead of them having to discover opportunities themselves, the opportunities are already brought into the network, which are made available to them. So as you can see, there's two sides to the equation. There's the borrower side and the lender side. As borrowers, more capital is being made available to them, and in an easier to access fashion, and potentially at a lower ultimate cost of capital. And to the lender side, there's more opportunities that instead of putting money into deposit or low interest-bearing returns, they're able to place it into a network, into a safe network to be able to get appropriate rewards. So is there a path to the promised land? Well, of course there is. The key difference with Octet coming into the picture is that we're an already established business. We're not a startup. And we have, as the guys touched on earlier, around $3 billion in transactional volume that we've had since inception, with around 32 now, closer to 40,000 members within our network. We operate across the globe in all unsanctioned countries around the world. We're starting with a really strong technology platform which already exists and does not have to be built. And the blockchain piece is leveraging this already existing network, which means that we've got very much a running start. We're backed by a very strong team of advisors and people within our business. Those who've had multiple businesses in the past, who've been at the top of their game in the supply chain financing world, both on the tech side and on the business side. And we think we've got a very strong and powerful proposition. You can find a little bit more about us at next.octet.com. And thank you very much for having us. We're a little bit early, so we can take a few questions as they come through. I'll invite the guys to come and join me as well.
Thank you, very interesting. If I'm a lender, is the loan secured by collateral?
Yeah, I don't think this is on. Is it on? Oh, hi. So in terms of collateral, how we work is much in the same way that a financier or a bank works. When you're lending into our pool, per se, I won't call it a pool, but the smart contract essentially mitigates that. But let's say, for example, you want to lend $100,000 how it works in how we work is that invariably one of the FIs or financial institutions will say, listen, we've got a warehouse of loans of $300 million. We want to grow, so we need another 100 million, let's just say. So what will happen is 100 million of loans that are already secured, so asset receivables, will be made available for the network to subscribe into. So invariably, if you think about it, $100 million of loans in let's just say, an international factoring environment will probably have 30 to 40 to 50% more than the net loan amount in asset receivables. So let's just say there's 150 million in receivables. You're lending at 70 or 80% of loans. So invariably, you're 50% levered at best. And that's why us as a business practice that and lend in that manner, because invariably you're always lending at a discounted rate and you're protected A, by the spread of all the receivables that you're buying, and B, by the discount that you're lending at.
So then as a lender, this receivable, this pool of loans, do you put out disclosure on how diversified you are across industries and so forth?
Correct. So each tranche, let's just say, or pool, will have essentially an IM or information memorandum, and it will highlight obligor spread, industry, class of asset, everything that's typified in the space. I think the whole point of the exercise for us is as a group to do two things. One is we really feel strongly about decentralizing the network itself, because it's clearly a mess from an FI standpoint, but also, because of the opportunity to bring in the individual and to bring them and give them access to, I suppose, train of thought that financiers and bankers have. Because if you look at the peer-to-peer space, it's a great space, but I think historically, no one's really thought about trying to equip, I suppose, amateur lenders with the knowledge that a bank or a financier might have. So, going and lending to the wrong opportunity can be quite onerous, where this way you're obviously privy to all the information, you're protected by the spread and the asset count that you're lending into, and you're also equipped with information to help you make the right decision.
One of the key difference there as well is that from a lender perspective, the smart contract comes into play, which was part of Justin's material, that part of the key elements of the smart contract enable you as an individual or amateur lender, as Brett said, to set your own eligibility criteria. And what that means is, say the three of us are lenders in the network. I might say, I only want to lend to businesses that have been trading for more than 3 years, that are profitable and that are not in the transport industry, as an example. And Brett might have completely different eligibility criteria, and Justin might have, again, completely different criteria. As opportunities or deals come into the network that meet those criteria and are able to be funded by the pool of people, those transactions can execute directly against the smart contract. So I know that as funds are being pulled through the execution of the smart contract, that everything is meeting the criteria that I have personally. So I don't have to worry, or Brett doesn't have to worry, or Justin doesn't have to worry about what it's being loaned into, because it's always going to match those eligibility criteria of the smart contract.
So my understanding of this is a hybrid between traditional financial lending institutions and crowdfunding.
That's right.
And the financial institutions, the traditional ones, they're doing all the legwork as far as assessing risk, and the crowdfunding is not, because they're not have the same business.
I think historically, just from our own experience, it's great to be idealistic about letting the individual do the sourcing, but unfortunately, if that were the case, and maybe it will be the case in 10, 15 years.
Yeah, I understand that.
Yeah.
So, but my question is there, is there going to be an equal split of percentage profits? Because the financial institutions are doing more of the work. Are they going to get the same percentage out of the loan, or as the crowdfunding pools, or is it going to be a little discrepancy because they've done more work? Second, follow-up on that, if a financial institution says, we've identified a really good product, and this is too good for even us to put into the Octet network, we're just going to take this one on our own, because, I mean, how are they locked in and making sure that the Octet network gets the fair share of the best of all the opportunities that they're seeing?
I think the way to look at it, once again, is like you would look at a securitization. It's not deal dependent, so that it's invariably when the FI comes in and they want to extend their network, or for example, a lot of FIs are tied in by their banks around eligibility. So they may not be able to do as many deals as they want in particular industries, or they've done too many in a given period, so then they're restricted to do more deals that make sense for them. It's invariably not that they can pick and choose the deals that they put in, it's that they're essentially allotting a whole stack of receivables into the network.
Ones that they wouldn't do otherwise.
Yes, correct.
That's the key.
And invariably, it's for them also to decide, is it the mezzanine piece that they want you guys to fund? Is it the senior? When I say mezzanine, it's kind of the, it's a higher risk return type proposition, where senior is typically what a bank will fund, i.e. there's a lot of buffer in between. It's the cheapest point. So in terms of picking and choosing, there's no real, I'll take this deal, you take that deal. It's really a whole warehouse and that's how we want to do many to one funding, because we see that as kind of how banks work, how FIs work, and bringing that power to the people.
Maybe just one last point, worth bearing in mind that these are classes of loans that otherwise FIs would not take exposure to because of the capital requirements. So ordinarily just leave them on the table, they're not even going to finance them. But now if they know that, okay, well, given my current position, I can fund 80% and I can get the other 20% from the crowd, suddenly it's an opportunity for them to capitalize on it when they wouldn't have before. So the main benefit to them is that they can actually participate in a deal that they otherwise would have shelved. And the benefit to everybody else is they have access to something that's profitable for them that they also wouldn't have had access to. I mean, it's better than leaving your money around in a bank or your retirement fund most of the time. I mean, it's pretty stable stuff.
One other point as well, just to touch on that, is that when the pool is put into the network, there's a bunch of receivables, or i.e. money coming back in, that pool essentially, if there were a problem, would be liquidated. So if they're choosing to put some higher spec deals or higher risk deals in, it's reflected in the IM and then it's priced accordingly. So there's full transparency. It's more around whether you want to participate in it or not. I think for the most part though, FIs block and tranche a whole pool of receivables with mixed, obviously they're all relatively similar in their risk because the whole portfolio is risk weighted, but yeah.
And finally, just to clarify there, that the crowdfunding piece is not to bring money in to fund deals that the financial institution wouldn't otherwise have done. It's not a poorer class of loan. It's not a loan that they wouldn't have done. It's not a loan where they think, oh, I've got this extra availability in funds, I'll just do that high-risk deal. It's not that at all. It's just being able to lend more into the higher quality opportunities. And the key difference of what Octet Next is trying to achieve, it's trying to connect crypto holder wealth or crypto holder capital and fiat capital with investment grade opportunities. Opportunities that as an individual, from a discovery perspective, it's impossible to be able to go and find. How would any of us as individuals be able to go and find businesses that are transacting more than $10 million in revenue or more than that, or profitable, look at their profit and loss, their balance sheet, their cash flow statements, potentially take security? None of us could do that. So the idea is that when those businesses come into the network as originated by FIs, they are at the investment grade level, which gives a massive opportunity to crypto holders, especially mature crypto holder wealth, that want to put that capital to work.
Okay, sorry that we're out of time. This has been a great presentation. But
Thanks.
Thank you, everyone.
Thank you.
can they still connect with you after the presentation here? You guys be in the back so they can connect with you?